You don't need an incredibly detailed multi-page retirement income plan to ensure that you can retire, but you do need to know the different options and strategies available to you. So if you're unsure exactly how you're going to create income throughout your retirement, be sure to check out this video where I walk you through 4 different approaches you can take and provide context as to which might be best for you. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. When it comes to retirement, the biggest priority you have is ensuring you have cash flow to support your needs throughout retirement. So essentially, you have a retirement income plan. Now, that being said, there's not one size fits all approach to creating that cash flow. There's many different ways you can do that, and in today's video, I'm gonna walk you through 4 of them and help you understand what might be best for you. Option number 1, the first strategy you can take is maximizing guaranteed income sources. Now, what do I mean by this? Well, most people, when they go to retire, they have various different things. Think of them as tools that they can use to create income. Maybe one is Social Security, maybe some is cash in the bank, maybe some is investments like a 401k or a Roth IRA or something like that. And typically, they pull a little bit from each of those things to meet their income needs. Well, that's certainly one approach, but what maximizing guaranteed income sources does is it fully focuses on maximizing that guaranteed income source, as the name implies, in order to create the entirety of their retirement income. Let's take a look at how this might work out in practice. Let's assume that you're 64 years old and you want to retire. Now, to retire, you need cash flow or you need income of $3,700 per month coming in, and that will allow you to live comfortably and do everything that you want to do. Well, you have 2 primary ways of supporting that or of generating that. You have a Social Security benefit that your full retirement age amount is $3,000. So if you wait until 67, you get $3,000 per month. And you have $300,000 in your portfolio. So maybe it's a 401k or Roth IRA, whatever it might be. Now, one option is to collect your Social Security benefit at 64. And if your full retirement age benefit was $3,000, you'd receive about $2,400 per month at age 64. So you have $2,400 per month coming in, which leaves a gap of $1,300 per month, and that would fully come from your $300,000 of investments. Now that's one way of doing it, and that way works. But here's the other approach. What if instead of living on Social Security and investments, you fully spent down your investments in order to let Social Security grow? Because in this example, if your Social Security benefit at full retirement age, so 67, is $3,000 per month, what that means is your benefit at 70, after 3 years of delayed retirement credits, even if you're no longer working, your benefit at age 70 would be $3,720 per month. So another approach you can take is to say, instead of spending some Social Security today and some investments today, I'm going to take that $300,000 investments and spend that down over the course of the next 6 years. So from age 64 until age 70, knowing that age 70, all my income needs are met from Social Security. To do that, you need to make sure though you have enough money in your portfolio. So will $300,000 really do the trick here? Well, $3,700 per month is what you need. If you multiply that by 12, that's $44,400 per year that you need to live on to generate all your income needs. Well, if you multiply that by 6, so that monthly benefit of $3,700 per month times 12 is $44,400. If you multiply that by 6, so 6 years between 64 and 70, it's about $266,000. What that tells us is if you put your $300,000 into something that's keeping up with inflation, some conservative investment that's just outpacing inflation, you would have enough to bridge the gap between 64 to 70, meet all of your income needs, and then turn on your Social Security benefit, which is your guaranteed income source, and that's gonna carry you on for the rest of your retirement. Now here's the downsides to that approach. Number 1, you could probably do a little bit better if you didn't spend down all of your investments at the very beginning. Now, there's no guarantee of that because there's no guarantees as to what the stock market will do or what you as an investor will do, but you probably have potential to do a bit better if you don't spend down all your investments over the first few years. Downside number 2, the future of Social Security may be a little bit uncertain. Now, is it likely that Social Security benefits are going to be cut on people who are already collecting? I wouldn't say it's likely, but you can't guarantee anything. And if everything is coming from Social Security, it doesn't leave you much wiggle room if something happens to that benefit. Another downside is Social Security is capped. So once you've filled up your Social Security wage base each year, there's a cap on how much Social Security you can earn. So you have to look at that cap. And today, for age 70, that cap is $4,555 per month. So if that cap is sufficient for you to live on, great, but you may find that it's not. Even if it's you and a spouse, it might not be quite enough. So if you're placing everything into this guaranteed income source, and this guaranteed income source doesn't meet your needs, well, then this probably isn't the best strategy for you. That being said, this is one approach that you can take to spend down cash and investments in order to increase your Social Security benefit and then live on that for the rest of your life. The second retirement income strategy that you need to be aware of is living fully off portfolio dividends. So your main goal in retirement is to create a consistent stream of income that you can live on. Your paycheck's gone away, so you need some stability, you need some certainty with regards to where income's going to come from. So most people, when they look at dividends, their first concern is, well, the stock market is very volatile. You might be way up or way down, and I don't want my dividends to be subject to that. Well, here's the thing. Dividends are typically pretty resilient. They're pretty sticky, meaning even as a stock market is fluctuating all over the place, dividends remain fairly consistent, at least relatively speaking. For example, between January of 1973 and October of 1974, the S&P 500 dropped almost 50%. Dividends weren't cut at all. So what you're receiving in dividends at the beginning of 1973, you continued to receive that income even as the stock market was cut in half. From March of 2000 to October of 2002, the S&P was cut in half again. Dividends did drop a little bit during that time period, but only by 2%. So while stocks dropped by 50%, your dividend stream only cut by 2%, and it quickly recovered after that recession was over. Now, during the Great Recession, from October of 2007 until March of 2009, this is where dividends actually were cut. So the stock market lost about 56% of its value over that time. Now, dividends didn't drop by 56%, but they did drop by about 23%. However, pretty consistent, relatively speaking, at least in regards to what the stock market did. And then a more recent example. In 2022, the S&P 500 dropped by over 18%. Dividends increased by over 10%. So even as the value of your investments was falling, the cash payment that you're receiving actually rose in 2022 if your money was fully invested in the S&P 500. Now, is that a guarantee that that will continue going forward? Absolutely not. But what it goes to show is that these companies that are paying dividends typically remain pretty resilient in terms of their ability to pay that dividend to you as a share owner. So that's an income stream that you can, relatively speaking, count on going forward. Now, here's the second benefit of dividends. They tend to increase faster than inflation. In 1960, the dividend on the S&P 500 was $1.98. By the end of 2022, that dividend had increased to $66.92. So over that time period, over that 62-year time period, dividends had increased 34 times. That's a compound growth rate on dividends alone of about 5.8%. So how does that compare to inflation, which is really what we need to compare anything to? Well, in 1960, the same time frame that we're measuring dividends from, the consumer price index was sitting at 30. At the end of 2022, it was sitting at 300. So it had increased by 10 times, which is an annual growth rate of about 3.8%. So when you look at this, over the 62-year time period, dividends have increased by 5.8% per year. Inflation had increased by about 3.8% per year. So when you look at the combination of dividends remaining pretty resilient and pretty consistent regardless of what the stock market is doing, and you combine that with the fact that on average, dividends are increasing at a faster rate than inflation, that's a pretty good combination for you as an investor to live on those dividends to support your income needs. The downside to this strategy is if you're only owning dividend-paying companies, you're missing out on some of the best companies in the world. Over the last 10 to 20 years, many of the companies that have performed the best were companies that didn't pay dividends. So don't get so focused on that immediate current cash flow that you miss out on the bigger picture of also ensuring that your portfolio is growing by capturing some of the best companies in the world. Another downside, at least as of this recording, the dividend yield on the S&P 500 is a little bit under 2%. Now granted, you could own just dividend-paying stocks and increase that dividend yield, but if you're owning a diversified portfolio, let's just say the S&P 500 for the sake of example here, that's only 2% of your portfolio that you're really living on. What that means is you need to create a more substantial portfolio base to create a given level of income, and there may be other ways to create a greater yield from your portfolio than just living on the dividends. The third strategy that you can look at to create your retirement income needs is to purchase cash flowing real estate. Now notice I didn't just say real estate. Some people think, oh, real estate's a wonderful investment, and while they can be true, or that can be true in certain instances, if you just go out, to use an extreme example, and buy 3 vacation homes, that's not a benefit to you. Yes, that's growing your net worth, or at least has the potential to grow your net worth over time, but there's no cash flow to you. In fact, it's actually a cash flow away from you. It's an expense, it's a liability to pay those property taxes, the maintenance, maybe the mortgage on that going forward. So when I'm talking about real estate in retirement, it's all about cash flow. It doesn't matter if you have $100 million worth of real estate if it's not paying you any income. You would need to sell it or refinance it, or at least get some renters in there to turn that into an asset that you can actually live on. So when we're looking at this from a retirement perspective, keep in mind it's always about cash flow. What's the income that you can generate from real estate? So to put this in proper perspective, you always need to compare it to something. For example, if you have $1 million property, let's assume there's no mortgage on it, and after property taxes and maintenance and other expenses, you're bringing in about $15,000 of net cash flow each year, you'd want to know, is that good or not? Well, what I would do, just very basic, this is not the most complex calculation you can do, but if you're receiving $15,000 of cash flow on $1 million asset, that's a 1.5% cash yield on that asset. Maybe not the best. However, if you have $1 million property that's generating, say, $65,000 in net cash flow each year, well, now what you're looking at is a 6.5% cash return on that asset. That becomes a whole lot more attractive. So you never want to look at any investment in a vacuum. You want to compare it to what could you be getting with different types of assets, with different types of strategies to ensure that cash flow is being maximized for your particular situation. Now, one thing I'll say with real estate is real estate can be a wonderful long-term strategy if you have liquidity to get through the tough times. So what are the tough times? Well, it's recession, it's the major repairs, it's tenants not being able to pay or not being able to find tenants. All of those things don't have to be a disaster if you have liquidity to see it through. So if you look at a time like 2008, for example, real estate prices dropped substantially. Now they fully recovered, but the only way you could get through that recovery is if you have liquidity to continue paying the mortgage, or you have liquidity to continue meeting your personal expenses while that value is plummeting and then rising again. Because if you don't have liquidity, well, now you're forced to sell that asset. And being forced to sell that asset is not a recipe for long-term success. So as your net worth grows in terms of how much real estate you have, make sure there's a proportionate increase in your liquid reserves to ensure that you can remain resilient and hang on to that real estate even when things aren't so hot. Now, a downside to this strategy is it takes work. You can get superior returns from real estate, but it takes your time, your energy, your effort, and maybe even your money if you're hiring a property manager to do this for you. So this isn't typically something I'd recommend starting at retirement. In fact, a lot of people I know, they have real estate, they have rental properties, and as they retire, they start to divest of them because they want to spend their time traveling or with friends or with family, or their time not having to think about managing something. And sometimes real estate requires that. So it can be a wonderful thing or it can be a terrible thing, but it depends upon you personally. So make sure you understand your needs and yourself personally to understand if this makes sense for you. The fourth strategy that you can look at is to apply a dynamic withdrawal rate. Well, what do I mean by that? A few minutes ago, I talked about living on just dividends. And depending on how your portfolio is structured, that might mean only taking 2 to 3% of your portfolio per year. Well, a dynamic withdrawal rate tries to answer the question, what's the most amount I can draw from my portfolio? Whether it's from dividends or interest or cash or selling some principal, whatever the case might be, what's the most I can take from my portfolio to fully meet my income needs in retirement? Now, Jonathan Guyton and William Klinger, they wrote a white paper several years ago to address this. And what they saw is that if you have the right portfolio construction, you can take between 5.2 and 5.6% of your portfolio value that initial year of retirement. And if you follow a series of rules, that portfolio should last 40 years or more with 99% level of confidence. Now, to make that happen, there's rules that you need to follow. They talk about the portfolio management rule. They talk about the inflation rule. They talk about different guardrails that you need to place around your portfolio. So there's a lot to it that I'm not going to fully get into in today's video, but this is a great way to say, how do you take your liquid assets and maximize the income that you can draw from them? So as you're looking at all of this, this is a high-level overview of 4 different types of strategies. A lot of people are really attracted to that concept of dividend income. And they'll ask, what's the least amount I need in my portfolio to fully live off just the dividends? Well, if you're asking that, I made this video right here where I solve for what's the lowest portfolio value you need to create dividend income to support all of your retirement needs. So check out that video if you want to see what the least amount you need in your portfolio is to live fully off the dividends. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.